Hello, I'm Mark Patton. In this investor workshop, I'm going to provide an update on the performance of super diversification through the first part of 2020, as well as taking a look at the longer term perspective as well. The workshop's designed both for our existing clients. Now, of course, existing clients can log into our website at any point in time and see the performance of your particular portfolio. But in this workshop, I'm going to provide a little bit more perspective on what's driving performance both shorter term and longer term. The workshop's also designed for those investors who are not currently invested with us, prospective investors, who might be interested in seeing an update on the performance of super diversification, especially given the bear market that we've seen here in 2020, as well as taking a look at how it's performed over a longer period of time. Before we dig into the performance of super diversification, let us remember what makes a super diversified portfolio different than other portfolios. I'm going to go to the Our Portfolios page of our website. So the bottom line is a super diversified portfolio is simply more diversified than traditional portfolios that include typically stocks, bonds, and cash. Super diversified portfolios include those, but also include such things as commodities, gold, real estate, our proprietary hedging strategy, and more. Simply a more diversified portfolio. Super diversification is a total portfolio solution. It's not meant to just be one piece of a portfolio, but it's a solution for an entire portfolio. And one of the real keys to super diversification is that it's built on what we call math that works. It's very simple. We're looking for things that don't always move up and down together in a portfolio and bringing those things together. It's about having investments with low correlations, and that really is what provides for the great diversification long term. In addition to that, we utilize low-cost index funds. Keeping costs low inside the funds results in a higher return for our investors. Super diversification or super diversified portfolios often include an allocation to our proprietary hedging strategy. This is one of those investments inside the portfolio that often doesn't move up and down at the same time in the same way as other things in the portfolio, again providing that diversification value. And one of the really cool things is that super diversification is built on the success of others. I didn't invent the concepts of low correlation and low cost. These things have been going on for a long time. There are folks out there that have been implementing these disciplines for 30 and 40 years. We're simply harnessing what they have done successfully and bringing it to our clients. And one of the last things is that every super diversified portfolio is custom built for each one of our clients. We have clients with low risk and high risk and all in between, so every portfolio is customized. Now, in this workshop, I'm going to present performance that focuses on a more growth-oriented investor, and I do that because the majority of our clients tend to be in that category. So that's what I'm going to focus on, but I do want to make it perfectly clear that super diversified portfolios can meet the needs of any investor, regardless if they want to have low risk or high risk or anywhere in between. Now let's dig into the performance of super diversification. I'm going to go to the performance page of our website that any visitor can access. This provides us the performance of super diversification going all the way back to January of 2010, which is the inception date of super diversification, through the most recent month end being March month end. This is a composite or average return of all of our clients in our super diversified portfolio with a growth orientation. As I mentioned earlier, that's the majority of our clients, so that's what we tend to focus on when we're showing the average performance of super diversification. As you can see here, during that 10 plus year window of time, the total or cumulative rate of return was just over 140%. That simply means that $1 invested 10 plus years ago, back in January of 2010, has grown to $2.40 through the end of March. So we're very happy with that rate of return, especially when we compare it to an industry average that is out there. So that's what's called an average private client index. There's a company out there that gathers information on a little more than 100 of our competitors, providing performance information on all their client portfolios. This index is one that has a similar risk profile to our super diversified clients with a growth orientation. So these are comparable indexes from a risk perspective. You can see during this 10-year window of time that the industry average has produced a return of just over 60%. So we're very, very happy with the performance of super diversification. Now let's take a look at a few more details in the performance comparison between these two, our super diversified clients and the industry average. I click on the view more performance data as you just saw, and you're going to see that we allow investors to compare us against 5 different indexes or comparables that we've made available. I'm focusing on this average private client, and you're going to see when we click on this display performance comparison, it now brings up a line graph so we can see the performance performance all the way back to January of 2010, you'll see that the graph starts at a 0 return on the far left-hand side, and obviously super diversification grew into 140% return versus this industry peer average of just over 60%. Again, we're very pleased with these returns. We can also take a look at the risk comparison. So I'm going to go down to this risk comparison dropdown, and it's going to show us these two different indexes side by side and look at some risk statistics. We'll start with volatility, which simply measures how much a portfolio moves up and down from month to month. So lower volatility tends to be better, and you're going to see that here with super diversification, that we've delivered a lower standard deviation or volatility than that industry average index that is out there, what's called the comparable, which is what we've made available here in this dropdown. You can also look at some other risk numbers, such as the worst down month, only being down 7.3% for us and 12.1% for that index, so we're happy with that. So we can look at a variety of different risk statistics, and you're going to see that super diversification not only has delivered a far superior long-term rate of return, but has done so with a risk profile that is certainly comparable, if not better or lower than that industry peer average. Let's take a look at how super diversification is done during the first part of 2020, which is really what we came to take a look at. We're going to go to this returns comparison report, and down here at the bottom, you're going to see the year-by-year comparison of super diversification versus that index of our peers. In 2020, now this number goes from the start of the year through the end of the most recent month. You'll see that super diversification has delivered a return down 11.37%. We're not happy with negative returns, but when you compare that to our industry peers and the average that's been delivered there, down 17.64%, we are very happy with the way super diversification is delivering returns during this fairly significant bear market that we've had. Now, to wrap up, I do want to provide a little bit more detail on this industry peer average, and we can click on this industry benchmarks link. And this will provide you with a definition of the 5 different comparables that we make available for you to compare super diversification against. Obviously, I've focused on this average private client index up here. You can click on this additional link here, and it's going to bring up a list of all the industry competitors who are providing performance information on their actual client performance returns to this consultant that then aggregates it all together into these different indexes. You're going to see that companies including Barclays, Citibank, Credit Suisse, Deutsche Bank, Morningstar, Prudential, these big investment managers out there providing performance information on their actual client returns and then being aggregated into this industry average. We think this is a very applicable industry average to compare against super diversification, and we are thrilled actually long-term, both long-term and here in 2020, how super diversification is delivering performance for our clients. What I'd now like to do is log into our website just as clients do, so I can show you a more updated performance of super diversification through the first part of 2020. So I'm going to log in here, and this is going to be something that all of our clients are very familiar with, but we log in here and it defaults us to our super diversified portfolio statements section of our website where our clients view their performance. This is a sample client portfolio that's a super diversified client with a growth orientation, just like we've been talking. This data, though, goes through the first part of April through April 16th, the most recent trading day. And the nice thing is that it's not only been a strong performance for the market, which is great, but it's also been strong for super diversification. Our super diversified clients in our growth model are up about 5% for the first half of April, which brings their year-to-date return to about a minus 7.5%. So we're pretty happy with that given the extreme volatility we've seen in the market and a bear market and so forth. Now, just one quick thing is that I'd like to share with you the asset classes included. And we talked about how super diversified portfolios are more diversified than traditional portfolios. We have over here a list of all the asset classes making up a super diversified portfolio, including U.S. large stocks, mid stocks, and small size stocks, who are spread across the entire spectrum of different size companies or U.S. stocks. We have international stocks, including both developed markets and emerging markets, who are spread across the entire globe. We're including commodities, gold, real estate, Berkshire Hathaway, and our flex fund or strategy. It's these alternative asset classes that really do make a super diversified portfolio meaningfully different than the vast majority of portfolios that are out there. These alternative asset classes, we've got a target allocation of just over 50% for our super diversified clients with a growth orientation. Then we have a bond allocation to U.S. government bonds down here at 15%. So that just gives you an idea of what a typical growth-oriented, super diversified portfolio looks like. But what I want to take a look at and kind of wrap up with on the performance is taking a look at what's really been driving performance during the first part of 2020. So this is a list of all the asset classes again down the left-hand side of the page, and I'm going to show you the performance of these asset classes since the start of the year. So going from 12/31 of 2019 through the most recent month end, and you're going to see these rates of returns over here. It's usually compounded for longer periods of time, but for shorter windows of time, you'll see the absolute return. But nonetheless, you're going to see we've got all the asset classes there. And let's scroll down and take a look at this graph. And it's been just a very, very tough environment. So U.S. large stocks, which is the S&P 500, has dropped 19.5% during the first quarter of the year. Obviously, has rebounded some now, but down almost 20% during the first quarter. Mid-sized stocks down 27%, and small U.S. stocks down more than 30%. So it has been a rough, it was a very rough first quarter and still is rough out there now. International stocks have been down as well. International developed countries, which would be Europe, Australia, Japan, down almost 23%. Internationally emerging markets down almost 25%. Commodities, which is predominantly oil, obviously the price of oil has been falling, down 42%. Gold has been a safe haven, so investors often will flock to gold and bonds, as we'll see here in a second. Flocking to gold is a safe haven during these bear markets, which is pretty typical, and hence the reason why we keep a small allocation to gold in our diversified portfolios. Real estate has not done well, down 28.5%. Berkshire Hathaway, Warren Buffett stock has been down with the overall market, down a little over 19%. Our flex fund, our flex strategy has held up well, down only 5%. It really has been a nice buffer in the overall portfolio during this bear market, so that's been a nice diversifier in the portfolio. And then, as I mentioned before, U.S. government bonds have done very, very well, up 10% during the first quarter of the year. That's pretty typical as well. U.S. government bonds are considered to be the safest investment on the face of the planet, and people often will flock to those during times of uncertainty and concern. So this gives you an idea of kind of what's been driving the performance of super diversification in our portfolios during the first quarter of the year. I hope this performance update has been helpful. I'm posting regular blogs on our website that you can access via our media center and clicking on blogs here. There's at least one blog a week being posted that I'm doing. You can filter this by different categories over here on the right hand side. So if you're looking for just some general market commentary about what's going on in the overall market, I do a blog at least once a week about that. Then in addition to that, if you're looking for information about our proprietary hedging strategies such as our flex strategy, you can click on that filter over here and look at just those blogs there as well. And obviously clicking on these will bring up the entire blog. So anyway, hopefully this is some information that might be helpful to you to stay up to date on market conditions and what's going on with our portfolios and super diversification. I hope all this has been helpful to you. I appreciate you all taking the time, and thank you, clients, very, very much for the opportunity to be of service to you and anybody who's out there who's listening who's not a client of ours but might be interested in learning about super diversification further and how we might be able to help you. Please let us know. Thanks so much.